All right, welcome back. It's episode 56 of the Avid Investor Podcast with me, your host, Josh Adamek. And today I am going to talk about AIPs investing in, with, and for our children. So, probably your first question many of you might have is what the heck is an AIP? An AIP is an automatic investment plan. And let me start by saying this. I cannot go on with this episode without first giving credit where credit is due. So, most everything that I'm going to talk about here today, I learned from my good friend and mentor, John Burley. And if you want to learn more about it, here's his book. If you're just listening, you're not watching the video. It's his book is Money Secrets of the Rich, and you can buy that on Amazon for $20. So with that, hear what I have to say, and then go buy the book if you haven't already done so. But anyways, let's move on. Oh, one other thing I should mention about the book. I talk about this book over and over again. I've probably read this book myself 4, 5, maybe 6 times. Every couple of years, every year or two, I just go through and I read it again because it's a good refresher. Get stuff in the front of the mind. And what's really important, what's really special about this book is what many people don't know is 100% of the proceeds of this book, the net proceeds, go to charity. So John is his first and foremost, he's a real estate investor. He owns a private equity company, and in addition to that, he does a fair amount of training and education. He never wanted to be an author. He never wanted to write a book, but one of the things that drove him to write that book was knowing that he had the ability to just donate all the money to charity. So if you want to do something good and learn in the mix, it's $20 on Amazon. So Money Secrets of the Rich, go buy it if you haven't already done so. So that's that. With that, let's move on. I just want to talk about AIPs, automatic investment plans, investing in, for, and with our children. So what is an AIP? An AIP is an automatic investment plan. And what that means is when it comes to investing, when it comes to long-term investing and doing something for yourself, investing for yourself, you gotta set it up. It's got to be automatic, because if it's not automatic, it's so easy. It's like going to the gym, right? It's so easy. If it's not ingrained in your daily habits, it's so easy to say, oh, I'll do it tomorrow, I'll do it next week, I'll do it next year, and then it never happens. So if you just set up your investments, no matter how small, or whatever, how small, how large, whatever, you set them up automatically, it just becomes habit, and you never know you never know it's gone, but it's there for the long term. So how do you set up an uh, automatic investment plan? Like what how do you go? Well, just pick your account, pick your investment vehicle, and then have it automatically drafted. If it's through an employer, if you're still working a W-2 job, if you can have your long-term investments, your retirements, withdrawn, deducted straight from your paycheck, and that for a lot of people is the best bet. For those of us who are self-employed, many of us still get a paycheck, but you can have that automatically deducted for your paycheck, or set it up that be automatically withdrawn for your bank account. Just set it and forget it. That's the best way to set up your long-term investments. If you say, well, I'll just go in and do this once a month, or I'll do it at year end at tax time, or I'll do it this time, chances are you forget, you get busy, you miss the deadline, and you're like, oh, I'll do it next time. I'll do it next time. I'll do it next time. Then 6 months passes, a year passes, a decade passes, and you're nowhere near where you want to be financially. So that's the truth. That's the fact in the matter. But I'm not talking in this episode so much about investing for ourselves. As grown as adults here, we can cover that in another episode. But one old friend of mine reached out to me and asked, what do you do? What do you do for your children? You keep talking about your kids and their investments, and can you shed a little light on that? Can you tell me what you do? She said, do you have an episode on that on the podcast? I said, no, but I will. So today I'm going to talk about investing in, for, and with our children through AIPs, automatic investment plans. So first things first, I mean, there's so many different avenues, so many things that you can do to help your kids financially for the long term. Um, and what may be the simplest yet may possibly the most effective plan out there is what's known as the 529 college savings account. So, when my kids were born, right now they're going to be 8 in a couple of weeks. But I think as soon as I had Social Security numbers, I was like, bam, 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 setting up, setting up accounts, setting up different things for the kids, and getting them rolling because I understand, the power of money. And I talked about this in a previous episode. Two things that we have, our two greatest assets are health and time, and you invest in one and you get more of the other. And that also holds true with investments. If it's not always all about the dollars, how much you're investing. It also has a lot to do with the time and the amount of time that you're investing. And I've talked about this in a previous episode. The power of compound interest, and compound interest. If you haven't had a chance to listen to that, maybe go back and check out that episode. It was one of the earlier ones. But compound interest either works for us or against us. And how it works for us is through our investment accounts, our AIPs. How it can work against us is debt, consumer debt, credit card, mortgages, um, car loans, compound interest and interest and consumer debt. I mean, I gave you this the calculations, the ROI on paying off your debt a couple episodes ago. Go back and check that out if you haven't done so. But if this episode is more so about how we get compound interest to work for us in our favor and more so for our children. So as I was saying, when it comes to the 529 college savings account, super simple to set up. I mean, you can go to any platform, any well-known established platform. Uh, Check them out. Fidelity, Merrill Lynch, I'm sure has something. Any sort of brokerage type platform, you can go on there and you can set up an account. All you do is for the 529, it's super simple. You put in some basic information, your name, all your personal information, your kids' names, their personal information, and you set the account up, link your checking account to it and have it drafted, weekly, monthly, quarterly, annually. I would recommend either monthly if you want to do weekly, if you're paid weekly, if that works better for you, do that. But at least monthly or quarterly contributions, because that it's you can contribute. Most folks it works well if you can contribute smaller amounts at a time, rather than one big chunk once a year. And everybody's definition of big is obviously different when it comes to dollar amounts in investing. But if you set it up to be automatically drafted, automatically set up, again, set it and forget it. So, there's the 529. What are the benefits of the 529? I mean, well, first, like major benefit of the 529 is it's tax-free growth. So you put in post-tax dollars and the growth is tax-free. Another great benefit of the 529, and don't like, I'm not a salesman, I'm not a spokesperson for Fidelity or Merrill Lynch or anything like that. I'm just telling you what the accounts that I have set up for our children, and why I think they're a good opportunity. So let me shut this off here, getting a call. But anyways, so we got the 529s. They grow tax free. Another great benefit is they can you can convert them to Roth IRAs. You can do a Roth IRA conversion. So, some people might say, well, my kids aren't going to go to college. I didn't go to college. Or what if my kids get a scholarship? Or, what if they go to trade school? Yeah. I mean, the 529 could still be used for trade school and certain things. But, what if they don't go to college? Or, what if they get a scholarship? Well, great benefit of the 529 is if it doesn't need to be used for schooling, then it could be converted to Roth IRA. And the another benefit is I actually saw this online this morning is a 529 can be transferred amongst family members. I'm not sure why you would want to do that, but I don't know. Maybe if somebody doesn't likes one kid more than the other, or they got one kid that's Ivy League and they need to transfer the funds, then they could do that. But I don't know why that. I guess there could be certain scenarios where that could be applicable, but it could be transferred amongst family members. So, that's that. I mean, the biggest thing is tax-free growth, and the Roth IRA conversions in the event that some or all of the money wasn't used for schooling. Can you deduct money from a 529 college savings account? Yeah, just like any other investment account of this type, there'll be penalties. So I'd highly recommend not doing that. So that's that. The 529. It's the easiest, most basic account to set up. I set it up when my kids were born, and I'm going to get into that in a little bit. I'm going to share a screen and show you an investment calculator. But first, I want to go down through some of these different accounts and different investment opportunities. But again, bam, 529, set it and forget it. Next up is, a possible Roth IRA. This is a tricky one because your kids have to have earned income. If you're a business owner, you can put your kids on payroll, give them a job, not just put them on payroll, but they have to have earned income. You got to give them a job. And that's, the definition of a job, and everything is has to be proven that they're not just getting a paycheck and they're actually working. So have your kids clean the office, have the kids clean your office, have your kids do some work around the business. I mean, a lot of people try to say, oh well, my kids are marketing. Are they marketing? Right. So if your kids are marketing, get them marketing, have them stuffing envelopes, have them writing out, if they're old enough, writing out handwritten letters. If you're doing mailers, have them sorting, addressing envelopes, stamping, helping you send out thank you notes to your customers, your consumers. Those are all great ways to get your kids involved. I know, I know my kids, and I'll probably get into this a little bit more, but I take them over to houses every once in a while, and I put them to work. I mean, they have a couple of investments of their own, and we go and visit them, and when we're there, we clean up trash. We whether it needs it or not, we'll clean up trash. We'll pull some weeds. We might fix a few things, odds and ends, but put them to work. If I have a project that's under construction, or something new that we buy, they always like to go walk through and check it out, and I don't take them probably as often as I could, but if I need to visit a project for some reason, on the evening or weekend, take my kids with me, and we walk through. I let them nose around, be nosy in the house, and we'll do something while we're there. We'll rip something apart if it's in demo phase. We'll clean something up. I'll walk them through. I'll show them some things. I'll explain things to them, how the heating system works, how the electrical system works, how the plumbing system works, and we'll just go through that sort of step by step. But there's different ways you can get your kids involved in the business and get them some legit earned income. Of course, that depends on their age and skill set and stuff like that. And but there's ways to work that. So there's the Roth IRAs. That was, that's not one that's for everybody. Excuse me, I'm just taking my jacket off here. It's cold now. It's getting warm in my office. But anyways, the Roth IRAs, that's that's a good one for the kids, but doesn't isn't applicable for everyone. Another thing that another investment vehicle is, if your kids or anyone for example, has money that is built up in a checking account or savings account or other type of investment account, you could do private loans. You could do private loans to real estate investors or even business owners. I prefer real estate because it can be secured by a note and mortgage. This is one of the first investments that my kids did. We had an account set up, and there was some funds in there, and my kids never invested in my business. I wouldn't. Not that I wouldn't, but I see opportunities to help other people as well. So I had a friend in the business that had a property, and he was looking for some additional funding to cover some renovations. My kids had an investment account, so we did a note and mortgage against the property, and I think they were like 2 years old at the time, maybe 2 into 3 years old. So they were then a private lender, in a real estate investment project. That was secured by a note and a first mortgage. Again, that's not for everyone. Highly recommend probably not doing that unless you're in the business and familiar with the business, because you have to understand, you know, the inner workings of the deal, and the opportunity that you're investing in. Especially when it comes to your kids' money, right? Family money. It's safety and security all day long for me. So, again, we did the private loans. Next up, of course, is just investing in real estate. If you have the funding available, and this all depends. These different ideas and topics that I'm talking about are all dependent on the amount of money that you have available in your kids' investment accounts. But when it comes to just straight real estate investment, buying houses, investing in apartments. Single family houses, whatever the case may be. You could do that on behalf of your children, with their money and with their accounts. And, we've done that. My kids, owned two homes before they were, I don't know, I want to say 5 years old, maybe. Um, had the opportunity years ago to buy a property in the South Side Slopes, decent part of town. And I was able to negotiate a creative finance type of deal. We bought it sub to the existing financing. So the money that was needed to secure the deal was, down payment, closing costs, some renovation, and then of course, we set it up as an Airbnb. So we had to, stage the property and put all the furniture in and, set it all up, which was very, very expensive. I had no idea. I wasn't wasn't fully prepared for that one, we were fully prepared, but I was surprised at what we ended up spending furnishing the home. But I guess it shouldn't have been a surprise. It's just caught me off guard a little bit when we started pricing all that stuff off, because I've renovated countless homes. I've built quite a few homes. I've done a lot of construction project, but I've never went out and just bought all the furniture you need to put into a home. Everything from the furniture to the forks to the napkins to and everything in between, had to go out and buy it in one shot, and plus have somebody put it all together and set it up. So that was a little bit of a learning curve for me. But my kids, before they were 5 years old, they had two investment properties. One's an active Airbnb that, like I said, that we did that we were able to set up with creative financing. They own that. It's in a great part of town. It was able, owned it for several years now. Set it up, built a great business, a great balance sheet with the Airbnb, and now prices have grown tremendously, and I see an opportunity here, for them to exit. So we actually just listed the property for sale, and it's out there, available for sale, an active turnkey Airbnb. So, it's not that they had to exit, not that they had to sell. I mean, could hold it for the long term, and it'll be worth more. But I see an opportunity here for them to exit and see a good growth, and leave a good opportunity for the next person. And so that's where we're at with that. Another one, they just had a nice little house over in the North Hills, a nice ranch, that was a good opportunity to add to their portfolio as well. Bought that. We had it for a few years and then sold that. They did well on the exit there. So what's next for them for their real estate? I don't know. I mean, we'll see. We'll see what we come across. I'm sure we'll be putting in something else in their portfolio. But what's really interesting about this is not so much, the dollars and cents, but having, the kids involved. Arthur, my son, he asks a lot of questions. And, we went last week or the week before, visited his Airbnb. It was empty. So we're getting ready to list it. So I went there, took him so he could walk through. And, we got there. So I was, the garbage was out front. So we grabbed some garbage bags. We cleaned it up. We straightened it up. I'm like, dude, this is your investment. You got to take care of it. Let's go. Let's pick up some trash. And he started picking up trash, and he walked down the sidewalk, picked up the trash, and took care of it. He went through, and he's looking around, looking around. He's like, so this is ours. This is mine. Yeah. I'm like, yeah, this is yours, buddy. And he's like, so people pay us to stay here. People pay us to use it. And he's like, yeah. I said, yeah, buddy, that's how it works. And he says, and that money goes into our account. I said, yeah, that's how it works, buddy. I said, there's expenses that come out of the gross. And I explained the cash flow to him from gross down to net. Not sure that he retained it all, but he asked questions, and I gave him some answers, gave him some explanation. And, that's how, that's how we start to teach the money habits at such a young age, and start to ingrain the good money habits in our children is by starting them now. Teaching them the difference, the basics, the difference between assets and liabilities and cash flows and expenses and all that stuff. I mean, every once in a while we'll be at the office and I'll pull up QuickBooks. I'll show them a balance sheet. I'll show them a P&L. I'll show them the account balances and things like that, and explain the flow. And, he's pretty impressed. Ask a lot of questions. Sarah does too. Just so happens that I was out with Arthur a couple of weeks ago and not Sarah, but Sarah's into it as well. And she likes to see her houses and her investments and learn about that. Excuse me. I just had to take a quick drink there, but anyways, so we have the houses, we have the real estate investments. Again, those are great opportunities for long-term growth. So, if you're able to secure, if you're in the business and the business, if you're not in real estate and you're not in real estate investing, I would highly recommend probably not going out and buying investment properties for your kids if you don't understand the market, and if you're not comfortable with the management and all the day-to-day. There's other ways to invest on behalf of your kids that are more so hands-off. You could do some passive investments with someone else, like I did with private loans, private investments. Again, I go back to the Roth IRAs, the 529s. I just want to explain the real estate and what we do. And that's that. So, the other thing that, I wanted to cover about, so that's like that's the bullet points of the investments that I have set up for my kids. The 529s, the Roth IRAs, they've done some private loans. They've done some real estate investments. They have their own LLC, with their investment properties. And then, the other thing that I kind of touched on, but I just wanted to hammer this thing home is, you got to be cautious, or you're not cautious, but you just have to be aware. 529s that convert to Roth IRAs. Roth IRAs, if you have those set up for your kids have full access to all this stuff. Once they turn 18. I believe it's 18 with the college savings account, but again, none of this matters. Like we want to set this up for our kids, and we want to invest on behalf of our kids. But none of this matters if we don't teach our children to be good stewards of their money and their investments. The absolute worst thing that you can do, in my opinion, is go out and create a very, very successful business, build a very, very successful business, or, build up, even with small increments over time, build up a pile of money. And everybody's definition of pile is different, but build up a pile of money that would go get transferred to your kids, at a certain age, or, in the event of your passing. The absolute worst thing that you can do is create that, but not teach your kids good money habits and understanding, how money works and what to do with the money and all of that stuff. And again, I'm going to circle back to the book, because I got to give credit where credit is due. Money Secrets of the Rich by John Burley, $20 on Amazon. It'll talk about the 7 steps to financial freedom and the 5 levels of investors, and AIPs, automatic investment plans, and all that stuff. So I'm probably just regurgitating a lot of the information that I got from the book, because like I said, I read it 4, 5, 6 times, something like that. So again, none of this matters. Don't even bother setting up accounts for your kids if you're not going to teach them to be good stewards of the money and teach them good money habits. That is key, because the worst thing that you can do is, in my opinion, is when your child turns 18, 21, 25, 30, whatever, you hand them a big pile of cash and they have no idea what to do with it, other than go blow it. And we all know that end up most people that come into large sums of money end up in a worse position after the fact than before they had the money, if they don't understand good money habits and how money works. So again, let's, if you don't know yourself, read that book, Money Secrets of the Rich. Another good one that I've read recently is The Psychology of Money. Great book. I forget the author off the top of my head. I was actually going to bring that in today and I slipped my mind. But anyways, The Psychology of Investing. And, one of the things that I pulled from that book that I wanted to talk about a little bit next, I'm going to do a screen share here, is it really hit home. So like, you always hear about Warren Buffett. Dude's super smart, amazing, financial, whiz when it comes to investing. Doesn't lose money, invests for the long term. Everything he does is for the long term. He's not a day trader. He doesn't flip stocks. He invests and he buys companies, for the most part. So, one of the things that, I'm talking about investing on behalf of our kids and starting them young, starting them now. One of the things that I got from The Psychology of Investing was about Warren Buffett. So most people, most people, when they start investing, when they, it's like when the light bulb finally clicks, or they hear, this podcast, or, something finally, they have children, have, health setback, or whatever that is, whatever that tipping point is that gets somebody to decide, shit, I need to start saving for retirement, or I need to start investing. That usually happens like between like 35 and 45 years old, when somebody really starts to like take their long-term investing seriously. And then so let's just say you start at 40 years old, right? And then you go to retirement, and you got 25 years, right? From 40 to 65. Let's just call it 40 to 65. Maybe it's 63, maybe it's 75. I don't know. For this conversation, we're going to call it 25 years, 40 to 65. Well, there was a mention in the book about Warren Buffett, and Warren Buffett is worth, I don't remember how much money. It's a lot. It's, hundreds of billions of dollars. Like it's a lot of money what Warren Buffett and Berkshire Hathaway is worth. And the exact ratio doesn't matter. But Warren Buffett is worth so much money for a couple of reasons. One, because he's a financial whiz. But two, and this is equally important, Warren Buffett had so much time to multiply his growth. Warren Buffett is now in his 80s, and he started investing in his teens. And what the book mentions is, whatever Warren Buffett is worth, I don't know, a couple $100 billion. I don't even recall. I don't even know. Maybe that's not even close, but it's a lot of money. Well, if Warren Buffett they did the calculation in this book. If Warren Buffett doing exactly what he did, rather than over a 70-year span, call it, because he's, started in his teens and he's in his mid 80s, rather than over a 70-year span, if he would have done it like most people over a 20 to 25-year span, Warren Buffett would be worth a fraction of what he's worth now. And don't quote me on this. You can read the book, you can get the numbers, but it was something like, I don't know, call it $200 billion is what he's worth. And maybe I'm way off on that, but it doesn't really matter for this conversation. Say $200 billion, because Warren Buffett grew it over 70, 75 years. And if he would have done it over 20, 25 years, like most folks, it would be like $10 or $20 million, like an absolute fraction of what he has with Berkshire Hathaway. And it's all because of time. So that's what I wanted to cover next, in this slide. So I'm going to do a screen share here. I just went I just Googled investment calculator, and this is something that you can do on your own. So if if you can see this, it's up on my screen now. If you're watching on YouTube or something, if not, I'm going to talk through it. So I just Googled, and you talk about time, the power of compound interest. So for those of you that don't know, the math is fairly simple, and this is why I set up accounts for my kids when they were born, because every day, every month, every year counts, even with smaller dollar amounts. If you're just doing $10 a month, $20 a month, $100 a month, whatever, you compound that over time. The more time you can compound over, it makes tremendous difference. So when you talk about compound interest, it's pretty simple, and yet most folks aren't aware of this, is that when you invest at 10% return compounded annually, the money doubles every 7 years. When you invest at 8% compounded annually, the money doubles every 9 years. So wanted to make sure I got that right. So 10 years at 10% interest, the money doubles every 7 years. At 8% interest, the money doubles every 9 years. So what does that mean? Let's just go with the 10% for conversation's sake. And we'll go with the 8%. That's easy too. So if you invest $1,000, and no other monthly contributions, nothing else. If you invest $1,000 and it's invested at 8% annual interest, 9 years out, that $1,000 is worth $2,000. 18 years out, that $2,000 is now worth $4,000. 27 years out, year 27, that what did I say? Yeah, that 2,000 is 4,000. It doubles every 9 years. So year 9, 18, 27, it goes from 1,000 to 2,000 to 4,000. So that's just an example with $1,000. Use it with a $10,000 example. If you had $10,000 to invest, $10,000 year 9, invested at 8%. $10,000 year 9 is now worth $20,000. Year 18, that 20,000 is now worth $40,000. Year 27, that $40,000 is now worth $80,000. So that's 27 years out, you're taking your $10,000 investment and turning it into $80,000 with nothing more than the power of compound interest. So if you want to play around with these numbers, and I'm doing all that math in my head. So if I made a mistake on the math, you get the concept. But if I made a mistake on the math and you want to call me out on it, so be it. But that's why I'm sharing my screen here. So I just Googled investment calculator, and what came up was calculator.net. And this is the most basic investment calculator that you need. You want to play around with some numbers. Hey, if I do this, what am I going to see? What am I going to get? And it's just amazing to see these sort of returns. So let's just take let's go back to the 529, for example, right? So let's say your kids are born, right? The day your kids are born, and you invest $1,000. And they will use that money, let's say, when they turn 18 years old and go to college. We're going to invest it at 10% or 8% annual. So again, this is calculator.net. It's a pretty basic investment calculator. You just fill in the blank, starting amount $1,000 after 18 years. We put in 18 years at an 8% interest. It's compounded annually, and let's do additional contributions. Let's just do $100 a month. Okay. Contribute at the beginning of each month. Okay. So let's hit calculate and see what this says. So $1,000 starting and $100 a month. Very small amount of money, in my opinion. uh, equates to $50,000 available for your children's college fund. So that's the total contribution on that was, this is interesting. The total amount that you put in to this account was $21,600. And the total interest earned, that's assuming it compounded at 8% annually. We know the market goes up, the market goes down, but should be able to average 8% annually. The total interest earned on this is $28,260.83 on top of the 21,000 that you put in. So one thing to note is I I did the 529s through Fidelity, just through the online platform. It was a no load account. There's no brokerage fees or anything like that. I think there's a small fee that goes to Fidelity, but if you actually go to a broker and go through a brokerage, you're going to pay load. You're going to pay fees in addition to that, and it's going to cut into your returns. So I just went online. I set the accounts up, and when they set your account, when you set your accounts up, you put in there how old your kids are and blah 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 blah, and what they will do automatically is the account in the first several years will be much more aggressive, right? And then one thing that's very important to note is when your kids get older, when they get closer to college age, to needing this money, you want to make sure that you're reducing that risk and putting, it should automatically through like the Fidelity type account. But you want to make sure when the kids get up to maybe like high school level or something, or maybe even before, that you're starting to move that money into cash, into cash and bonds, safety, security. Because the last thing that you want to see happen is you put all this money into these accounts, and then you got $50,000 in this example saved up for your kid's school, and then they're in 11th grade and there's a market correction, the stock market tanks, and you got all your stuff in risky investments. And again, that shouldn't happen with the automated Fidelity or Merrill Lynch or whatever account you decide to go with. But you just want to be aware of that, is you want to make sure as you get closer to needing this money, much like your retirement account, when you're in your 20s, 30s, even your 40s, you can risk. You can be aggressive and risk the investments in your account, because you have time to ride those ups and downs and correct. But when you get closer to retirement, you want to, the closer you get to retirement and using that money, needing that money, wanting to draw from that money, you want to move it into to safer investments. So that's a good thing to note. But again, this example, this was $1,000, 18 years, 8% interest compounded annually. Now here's another interesting one. So we talked about how you can convert from a 529 to a Roth IRA. So let's just say your kids don't need this money. They go to don't go to college. They get into their own business. They take over your business, whatever. They get a scholarship. They just don't need this money. Well, great. Let's convert it to a Roth IRA. And again, Roth IRAs grow tax free. So this total interest earned, this is all tax free. Winner. But again, that's on this example alone is $28,000 in interest, tax-free interest. It's huge. You're not paying taxes. And for those of you who don't know, you're somewhere in a 25 to 40% tax bracket. So if you're 25% tax bracket and you were paying earned income on this, that would be close to $7,500 in taxes that you would have to pay on this 28,000. If you're 40%, it's a lot more. I'm not going to do the math in my head here. But anyways, let's go with this example. Now, right now we have 18 years, assuming they're going to use this money to pay for college. Now, let's say now they're 18 years old. We convert this to a Roth IRA. And when are we going to retire? We'll say 60. So if we add, let's just go with 65 years. Okay. So if we started this when they were kids, kept up with the $100 contribution, started with $1,000, now we go over 65 years instead of 18 years, because that's, around then is when you can start drawing on the Roth IRA. So let's calculate and see what it says. Boom. If you're not watching the screen, pull up calculator.net and do this for yourself. So $1,000 starting over 65 years, compounded at 8% annually with $100 a month contribution, has an end balance of $2,460,000, $460,405. So almost $2.5 million for your kids at retirement with nothing more than $1,000 down, $1,000 to start, and $100 a month. Total interest. Okay, so here's the big one. The total contribution on this over that 65 years, assuming someone keeps up with that $100 a month contribution. And again, an AIP, set it and forget it. You get $100 drafted from your paycheck or pulled out of your checking account. I mean, that's less than a cell phone bill. I mean, $100 is nothing to most people. It doesn't get you very far today, that's for sure. So $100 in an AIP over 65 years equates to almost $2.5 million, and that's 2.3 over almost $2.4 million in earned interest. So, okay, well, that's great. Let's just, for fun's sake, because everybody's different, right? Everybody's different. So let's just say you're doing really well, you run your business, or you got a really good job. You want to start your kids with, let's go back to 18 years. Let's go back to 18 years. Okay. So starting amount, you're doing really well. You want to start with $10,000, and then you want to do, let's just say, $500 a month. Still six grand a year. Not a ton of money for most people, right? For a lot of people, it's $6 grand a year is a lot of money for a lot of people, but for many people, $6 grand a year is doable. So 10,000, you're going to start with 10,000. You're going to do $500 a month for 18 years. There you go. You can send your kids to Harvard, I think. 10,000 starting point, 18 years, $500 a month, with 8% compounded annually, has an end balance at year 18 of $274,000, over $250,000 with $10,000 starting point, $500 a month. So $6 grand a year can get your kids set up for $250,000 at year 18. Well, here's the kicker, right? And I don't know. I got to go back and look, see if there's any limitation on contributions to a 529. Maybe that is, but you can do this through other accounts, through other investment accounts, and get the same um, uh, the same end result. So this is 10,000 a month, 18 years, 8% compounded annually, with a $500 a month contribution, has an end balance of $274,000. So total contributions you made over 18 years is a little over 100,000. Total interest earned is a little over $156,000. So talking about doubling your money and then some. So let's do this for you want to blow your mind here. Let's change this. Okay, let's go with the same assumption that this gets converted to a Roth IRA. Oh, and by the way, this couldn't be in a Roth IRA because that would be over the max contributions. But let's just say this is another investment account. We're looking at compound interest and not specifically talking about what account it's in. This could be mixed over multiple accounts, and you get the same end result. So let's say this goes 65 years. Okay. For anybody that can't see that, the start amount is $10,000. Growth over 65 years, compounded at 8% annually. $500 a month contribution, has an end balance of $13 million, a little over $13 million. You started with 10 grand. You contributed a total of $390,000, and your total interest earned over 65 years was a little over $12.6 million. So you've contributed $390,000. You let time do the rest, and you ended up with $12.6 million in growth for a total of $13 million. So that's that. That's the power of compound interest. It's just amazing, amazing. If you see, you want to have some fun here. Let's just say you guys are banging it. You're doing really, really well, and you can do $1,000 a month, 12 grand a year for your kids. It's $23 million at age 65. So this this is something I definitely wanted to share. Uh, so well, you know what? Let's go back. Let's look at the alternative, right? So before I end this, let's do $1,000. You're going to start, right? Let's go back to 18 years, 8% annual, and you're going to do $100 a month, right? So that right there gets you $50,000. $50,000, and I'll show you why. It's important to start when your kids are little, because this is 18 years. Let's say you start when they're 6 years old. So look at this. The total interest is $28,000 over 18 years for 50K total. Let's just say you waited till they were 6 years old to start the accounts. It's cut in half. Cut in half. So you now have an end balance of $26,000. Total contributions of 14.4. That's 1,000 down, $100 a month, and then total interest of 10,000. Still, if your kids are 6 years old, they're 8 years old, they're 10 years old, they're 12. Start. It's never too late to start. However, if your kids are little or you don't have kids yet, you have kids on the way, start as soon as they're born, right? In my opinion, you just saw the facts are right here. The investment calculator, calculator.net is where I'm at. You can go to any investment calculator. This is just the one that pops up top of the list, when I Google it, and I've used it quite a few times. So the power of compound interest here. Your growth is cut in half if you wait that extra 6 years to start. So let's take that back to 18 years. Okay, what do we think like college is right now for kids? Is it like $40,000 a year or something like that? $50,000 a year, like $200,000 to put a kid through college? I don't even know. I don't even know yet. My kids are 8 years old. I'm sure I'm going to get a shocker with that one when the time comes. But let's just say we need 200,000. Let's say we need 100,000 for our kids to put them through school. I don't know. Does that sound about right? Probably 150, I think. You always hear about kids coming out with. So what do we need to get $150,000? We could start, let's say if we start with 5 grand when our kids are born, 5 grand. And then we go up to, let's just say $250 a month. There you go. $5,000 starting point, 18 years, 8% annual, $250 a month, which is what is that? 3 grand a year? Not a ton, it's still a fair amount of money for a lot of people, but not a ton of money. So if you did $250 a month, 5,000 starting, 18 years, 8% annual, you have an end balance of $137,000. Your total interest earned is a little over $78,000. Your total contribution is 54. So you're more than doubling your contribution with nothing more than letting time and a decent market do it for you. So okay, so 5,000 are kids. Okay, kids are super smart, athletes. They get a full ride here. They don't need this $137,000. What happens if we take it out to 65 years old and you decide you still like them, you want to keep those $250 a month contributions going, or once it's converted to a Roth IRA, they have a job, they have a paycheck, bam, they start getting $250 taken out of their paycheck from day one. It's the best thing you can do from day one. So what do we get when we calculate that? Bam. All right. End balance of, so that was starting with $5,000, 65 years, compounded at 8% annually, $250 a month contribution, has an end balance of $6.5 million from $250 a month, right? So your total contributions on that, this is a shocker for most. The total amount of money that you wrote checks or deposited into this account was $195,000. The total interest earned at 8% compounded annually is little over $6.3 million. So talk about the power of compound interest, and just take a look at this investment calculator. And it's this is something that you truly want to understand, and understand finances and money. And again, Money Secrets to the Rich, check it out. The Psychology of Investing, check it out. All I've been talking about here for the last, I don't know, 10, 15, 20 minutes is the power of compound interest and how we can get compound interest to work for us instead of against us. And it works for us with small amounts of money. In the grand scheme of things, this is a small amount of money. Take a look at what you spend $100 a month on, or what you spend $250 a month on, or $5 grand a month, or 10 grand a month. I mean, I have some people that are dropping, $10,000, $20,000 a month on clothes and other bullshit. Like, sure, the bag looks cool, I guess, but what if you took that 5 grand a month and put that in your long-term investment account, invested in real estate, invested in assets, and forget about the liabilities, forget about the bling. Like, run these numbers. You want to be a decamillionaire, you want to be a billionaire. That can happen depending on where you're at. I mean, that can happen with a strategic plan and time. Like, time is how you get these end results, right? So, um, I'm going to cover that more in another episode. I'm going to save that because we're just talking about our kids here for now. And I'm coming up on 50 minutes, almost an hour here. So pretty passionate about this. And I could keep playing with this calculator.net. It's interesting because one of my good friends and a mentor of mine, we talk about this almost daily. He's in semi-retirement, in wind down mode. He's in his early 50s, and yes, he's gearing up to wind down in his early 50s. Why? Because he's made these decisions early on, and he's done very, very well, and always lived well below his means, and invested, and grew a tremendous business. So he's in his 50s, he's in wind down mode, and we talk about this almost daily. Well, I'm working on a business transaction, or he's working on something, and he's like, if you just took X and threw it in the market, threw it in the account, threw it in the long-term investment over this amount of time, and it comes up almost daily. So I would highly recommend play around with this investment calculator. Again, this one's calculator.net, but you can go anywhere. And once you start realizing, like, look at all, try to set something up for your kids, because that's what we're talking about today. But also figure out where you're at financially, what you can afford to just stash away, whether that be into an investment account, into some real estate, into whatever, passive investment in real estate, into the investment account, wherever you want to go with it. And just look at the results that you can get when you have a little bit of discipline and time. And that's it. So, hope I covered that. Answered any questions that you guys might have had on investing on behalf of our kids. So it was all about investing in, for, and with our children through the 529 college savings accounts, Roth IRAs, private loans, real estate investments. And then, again, first and foremost, let me just hammer on this one more time. If we're going to set this up for our kids, nothing matters. None of this matters unless we're going to teach our kids how to be good stewards of their money, and understand good money habits, and practice good money habits. Yeah, sure. I mean, a lot of this, if you set this up, a lot of it can be controlled through trusts, in your state, your family limited partnerships, and other accounts and entities, and there can be a lot of control, and controls and measures put into place even after your time, for next generation or generations to come. Like you can set that all up through revocable trust, irrevocable trust, family limited partnerships. However, like we just got to make sure that we're teaching our kids to be good stewards of their money and do good things for good people. That's the end of it. That's the bottom line, in my opinion. But everybody wants to see. A lot of people want to see. Oh, they got to make it on their own. They got to do this. I did. A lot of other people did. Started with nothing and built a business and hit a lot of challenges and roadblocks along the way, but kept pushing through and ended up being in a good spot, in a much better spot than when we started. But at the end of the day, me, personally, now it's generational. Like kids are up next. It's, doing this for the kids. I would love nothing more than one day to, work with my kids, have them in the business, involved in the business. If they do, great. If not, no worries. Maybe I can go work for them um, when they're old enough. But anyways, that's that. Let's wrap it up today. We're coming on almost an hour. Hope I answered your questions and helped you understand investing in, for, and with our children. And let me know. Let me know in the comments. Hit me up. Let me know what you thought of this one. If you have any feedback, please hit me up. Let me know. If you have any questions, anything else you want me to cover in another episode, let me know. I'm here, open for ideas. So that's that. Hope you all have a great day. Thanks for tuning in.